What's up, everybody? Everything Real Estate Podcast, episode 20. We got a guest, Sid. Tell us a little bit about yourself, man.
Yeah, so I've been in the financial services industry for 33 years, and I started offering insurance and mutual funds and group employee benefits. And then in 2000, I pivoted completely to real estate, all things real estate, and started to do loans, to do investment properties, buying and selling properties. So essentially, lending, reverse mortgages. Uh, but the main part of our business is offering, enabling people to do 1031 exchanges into DST structured properties.
Okay. So I got a couple questions for you because there's probably some people that are gonna be like, "What's a 1031 and stuff like that." So I got some questions for you. Could you provide a brief overview of what a 1031 exchange is and why it's a valuable tool in real estate investment?
Yes, yes. So it's actually one of the most valuable tools out there, allowed under the current tax law. Is it allows people to defer capital gains taxes and recapture of depreciation. And as long as they do that on their investment property, they never really pay the capital gains taxes or recapture depreciation. And they can keep deferring these taxes from one property to the other. So once they sell one property, do a 1031 exchange, go into another property, do another 1031 exchange. So essentially, it becomes a swap till you drop type of scenario. And then your heirs or beneficiaries get a stepped up basis. So essentially, all the capital gains taxes are wiped out and recapture depreciation is wiped out. And the only taxes that may be due are estate taxes at that point, but that's a separate conversation. Um, so, if, and just to give you an example, if someone bought a property 30 years ago and they paid $50,000 for that property, and that single family home in California now 30 years later appreciated to $3 million, for example. So now
Okay.
the capital gains taxes, if the 1031 exchange tool was not deployed, would be on 2.95 million and the associated depreciation recapture. So as a result of that, the investor can lose up to 50 to 55% of their monies in taxes and depreciation recapture. Now that's a really bad outcome if they or their real estate broker did not know about the 1031 exchange opportunity. So we educate our investors on that opportunity that's available to them. And so, under the 1031 exchange rules, briefly, you need to replace the equity that you relinquished on the property that you sold
Mhm.
on the upleg, and also you need to relinquish the debt that you relinquished. If you don't replace the debt or the equity, then it's something called boot. On the excess, you get taxed. So most investors generally are able to replace the debt and the equity. Now, sometimes we get investors who may have 70% debt, 80% debt on the relinquished property. And for those type of investors, it may become a little bit difficult to replace all the debt. But we do have properties with high debt to loan to value ratio. So we're able to accommodate those investors as well. So now on the other side of the 1031 exchange is what we have DST properties. These are structured under the Delaware Statutory Trust and under the IRS Revenue Ruling 2004-86. So if you go to the Internal Revenue Service IRS.gov website, type in 2004-86, then you will see all the rules regarding 2000, regarding the DSTs. Now, DSTs are very special in the sense that uh, they differ from the LLCs, the limited partnerships, the tenant in common form of ownership. And first, let's address the tenant in common ownership. The tenant in common ownership was also structured in the securities under IRS Revenue Procedure 2002-22, and in which you could have up to 35 investors, and the properties being $50 million to $500 million worth, it was a pretty high bar for the investors to come in with $1 million each minimum.
Right.
And so when the 2007-2008 crisis hit and the properties went down in value, the investors could not agree whether they would all want to refinance it, whether they would want to sell it, and the equity disappeared. And when the capital call came, some investors agreed to come in with the additional capital, most didn't, and the properties had to go back to the lender. So it was not a very efficient way to manage these properties under the tenant in common structure, the TIC structure. Now, a lot of smaller real estate brokers, they tend to have their own investments, and they'll say to their friends and family and to other investors that, okay, I'm buying 20plex in Texas, and it's a value add, and but then they'll put the structure as a LLC or a limited partnership. Now, it's okay to put it in that limited partnership or an LLC, but when the time comes to sell that property, all the investors are married to each other. If one investor leaves the partnership, they have to pay the taxes. So if the entire partnership does a 1031 exchange, then they can defer their taxes and capital gains, right? But if they don't, then they have to pay the tax. Same thing for the LLC, right? And then in the LLC and the LLP, the partnership or they get K1s. In the DST form of ownership, number one, each owner owns their piece of property, the fractional interest, as a separate piece and parcel for tax purposes.
What's
So
K1? What's K1 for
K1 is a
K1?
form of it's a tax form. It's
Okay.
a tax form that investors get if they own investments in a partnership or an LLC, limited
Perfect.
liability company or limited partnership, right?
Okay.
So in a DST, they can all go their separate ways when the property is sold. So in the DST, number one, we can have up to 500 investors. So in a $50 million property, if each investor came in with $100,000 each, they could get into a quality, institutional quality Class A property, financed, fully managed, and everything is done for the investor. They don't have to deal with the 6 T's of real estate investing. Now, what are the 6 T's? Dealing with tenants, toilets, trash, turnover, trouble, and termites. So when investors buy real estate, generally that's what they have to deal with if they have a duplex, fourplex, 10plex. But if they go to a 300 unit apartment complex through a DST property, not only are they getting an institutional quality Class A property, new to newer, but they're also getting fully managed property, fully financed with a non-recourse loan, and everything is done for them. The accounting is done for them. The property is has its own management, uh, own setup, and you get your checks deposited directly to your bank account. As long as the properties are cash flowing, they are 80 to 90% leased. So the properties in the DST are usually mature. Mature meaning they are 90 to 95% leased at the very
Okay.
minimum. A lot of investors, at least in California or all over the country, they will buy a single family home. And even if they don't have cash flow today, they'll buy it in the hope of getting cash flow in the next 10 years, 15 years, 20 years, and fund the property out of their pocket. So to those investors, I say, well, why would you want to do that? If you're going to buy investment real estate, you need to make money today. It's not tomorrow. It's not day after. It's not 10 years from now. You have to walk away with the money today from day one. Otherwise, you're literally buying a candy store. You're paying for the privilege of having a candy store. And then on top of that, you're giving away the candy free. So
Right.
if you want to be Santa Claus, that's okay. But you're not in the charity business. You're in the investment business, right? We want to be entrepreneurs for the one reason and one reason alone is to make a profit. So, regardless of the interest rate environment, if the deal makes sense and you're making 4 to 5% net cash flow in your pocket today, you do the deal. Whether the interest rates are 8%, 10%, 20% does not matter. In the 70s, interest rates were in the 16 to 18, 20%. People were still buying commercial real estate. People still bought homes, right? But the deal has to make sense. So in the DST properties that we buy, or our sponsors buy rather, the debt service coverage ratio is 2.5 to 3 times the debt service needed. So for every dollar of debt service, there's 2.5 to $3 left over after paying for principal, interest, taxes, insurance, maintenance, um, all the expenses, and then the net of that, that's how much monies are left. And then after paying for the principal and interest, the bottom line is you still have 4 to 5% cash left on a monthly basis, right? So that's what the name of the game is.
So how can someone get started in this venture with you? Like, is it a tough to get qualified for, or how's the qualification process?
Okay, so the only qualification that we need is for the investor to be accredited, to be an
Got
accredited
you.
investor. What an accredited investor means is that they need to have a minimum net worth of $1 million, excluding the value of their home. So if they have assets of a net worth of $1 million, and including the value of their home, or for a single person, if they made $200,000 in income for the last 2 years, or a couple, they made $300,000 a year income for the last 2 years. So then they can qualify as accredited investors. For LLCs, partnerships, for different entities, the minimum asset requirement is 5 million. So they need to have assets of 5 million, and then they can be considered accredited investors. The reason why SEC came up with the accredited investor rule was that the accredited investors are generally considered sophisticated, able to understand complex investments, and they are experienced in these types of investments. They are able to stomach the risk because real estate, to begin with, is illiquid. When I say it's illiquid, meaning you can't just buy today and then sell it tomorrow. You can do that with REITs. So if somebody wants to buy real estate, get into real estate, and sell it tomorrow, trade it like stocks, the publicly traded REITs are fantastic because you just go in, you buy a REIT or multiple REITs to diversify your portfolio, and they trade all day long. You can sell them, and then you get dividends on those. So you get 1099 tax form on owning a REIT. So for someone who's looking to get their feet wet and they don't have $1 million of assets, net worth, I would recommend that they get started in REITs, go through their broker or online, however they want to acquire those types of investments. So if they're already invest in mutual funds, already invest in stocks, bonds, ETFs, then REITs may be a good way to go. But for someone who's looking to get cash today, yes, they can do it on their own. But if someone wants to focus on what they do best, so if someone is a physician, for example, and they don't have time in the day to answer the tenant's call that, hey, my toilet is stuck, or my lock is not working, or the window is broken, and they don't want to get that call when they're eating Christmas dinner, then for that type of a person who's very busy with what they do, a DST type of a structure may be the perfect answer. So it's great for investors who are looking to diversify out of their securities portfolio, the paper-based portfolio and ether for that matter, because all you see it is on your computer screen. It's not like the old days where you used to get stock certificates, right? Into brick and mortar assets. So real estate is a brick and mortar asset, right? And as long as there's an expectation of income and they're structured properly, the due diligence has been done, they tend to give cash flow unless and until really bad things happen, like it happened to the office sector in the last couple of years, where the buildings sort of emptied or the leases did not get renewed, or tenants are fleeing downtown areas. So that can put a damper on people who are simply invested in office. But people who are diversified in apartments, in essential retail, like a shopping center, grocery stores, medical office buildings, um, warehouses, commercial, industrial, uh, companies like Amazon, FedEx, UPS, they tend to lease um, 500,000 to 1 million square feet of space for the last mile delivery. And then storage. Storage is evergreen, which has the lowest maintenance. All you really need is a bulb, and there's literally no other maintenance, no air conditioning, no heating, and it pays cash. So as long as someone is diversifying into multiple property types and at a minimum $100,000 a clip, and in different states, different geographic locations, different tax jurisdictions, states like Nevada, Florida, Texas, Washington. A lot of states are income tax-free states. So at least you don't have to file the income tax, you know, filing there, and no tax. So it saves on tax prep fees, and you don't have to pay the tax either. So which is fantastic. So that increases your net return somewhat. So the name of the game is, if you're going to be investing in real estate via DST Properties, you do have the ability to invest $100,000 in a $50 million property and be a part of that institutional quality property that banks, insurance companies, uh, private equity, retirement funds buy and sell to each other.
Sorry about that. I got kicked out, brother.
Oh, okay.
What's the difference? This seems like kind of like syndication, right? Or what's the difference between DST and syndication?
There's no difference. It is exactly syndication. Um, and basically, the sponsors, they go out, and for every DST properties, they look at 20, 21, 25 different properties that are out there. And they do 4 to 5 rounds of due diligence before they acquire any property. And they buy these properties with their own money, 5 to 10% down with their own money. Then they usually put financing uh, for 40 to 50% loan to value. And then the rest of the money is bridge financing. The bridge financing is retired as the investor equity comes in. So the interests of the sponsors are aligned with the investors in the sense that they own 5 to 10% of each property. So they absolutely are committed to performance of the property to deliver superior returns to the investors. And as long as the market conditions are right, and they usually own the properties for 5 to 7 years on average, and they will sell the property. Because they're professional money managers, they're professional real estate owners, they don't fall in love with the property like a smaller investor might fall into, a mom and pop investor. And they may say, I have this home for the last 30 years and I really like the tenants and we have good relationship, and I don't really want to sell the property. I don't want to kick them out, right? These guys, they don't really fall in love with anybody. Their responsibility is to the investors. It's somewhat comparable to a CEO of a company who has to run the company to make a profit, and they're responsible to shareholders, right? So, in the same way, the ESG sponsors are responsible for the investors that hold fractional shares in their properties. And if they do good for the shareholders, for the investors, then that investor is likely to reinvest with them. And then from us on the broker side, if these sponsors have done good for the property investors and they have a good track record, then it makes it easier for us to recommend these sponsors and their properties to the investors. But again, the properties, with our own due diligence from our broker dealer, we do a complete due diligence. We have a property pipeline from $1 billion to $2 billion on any given day, 25 to 30 properties at any given time, and we give them the whole analysis. What's the cap rate? Uh, what is the debt service coverage ratio? What is the cash flow? Their location, the prospectus on each property, and the prospectus has to contain all material information on each property. So, under the Securities and Exchange Commission umbrella, we have to be on the disclosure. It has to be a complete and full disclosure. And not only that, because this is a securities offering, the investments that we ultimately recommend to an investor, show it to them, discuss with them, it has to be suitable for their risk profile. So the
Right.
suitability is the key, right? So the amount of hand holding that we do compared to a real estate agent or real estate broker who are not required to do that type of a fiduciary responsibility, we have to exercise that fiduciary responsibility. We have to look out for their best interest for the investor. We have to put their interests ahead of us. We cannot have any conflicts of interest. So I think from that perspective, the DST structure is a pretty well thought out structure because it's offered under the securities umbrella. So now, if you were to ask me, why are these properties structured as securities and not as simple real estate? Because they are real estate at the end of the day, right?
Right.
There was there was a Supreme Court case on SEC versus Mr. Howey. He was a Florida citrus farmer, and he, as far as I remember, I'm sort of paraphrasing. He set up a citrus farm in Florida, and he got together friends and family and some investors, and said, "Look, I'm setting up this citrus farm. We're gonna grow orange trees. We're gonna farm the oranges. We'll squeeze the juice, and we'll sell the juice, and we'll share the profits and losses." Right? So he just formed his partnership, and he started to do that. And then the Securities and Exchange Commission, uh, someone either made a complaint or they found out or whatever that thing was. Eventually, the case ended up in the Supreme Court because Securities and Exchange Commission said, "Well, look, what you're doing is you're essentially selling securities." And Mr. Howey, he disagreed. He said, "Look, I'm just doing business. I'm a simple businessman. I put together this partnership, and we're just sharing the profits and losses. What's wrong about that?" So the Securities Commission disagreed with him and said, "Look, no, you are working for other investors, and they're earning passive income through your efforts." So the Supreme Court agreed. So essentially, that became known as the Howey definition of security, that if an investor is earning money through the efforts of others, it's automatically a security. So you will see in the normal business in many states, in many areas, you'll see real estate brokers putting these partnerships together, and they have all these investors coming in, and they say, "Okay, you guys don't have to do anything. The general partner takes care of everything." If, in my opinion, if they get sued, they'll probably end up in federal court, because once these things are ruled as securities, then the state courts won't have jurisdiction. So that can be another layer that that investors need to be aware of. Uh, that what they're buying is essentially they're buying into securities, and they're not limited partnerships for the purposes of federal securities laws. So what we have is essentially a very well thought out structure. The DSTs also prevent the sponsors from refinancing a property. So it does some really good things. One is the the interest rates have to be locked up front, right? The financing terms have to be locked up front. So then there's no risk of financing. There's no financing risk. And then there's no economic risk. Because if the markets start to go down like they are now, right, and properties are and properties start to go down in value, and therefore their equity starts to disappear, then there will be a capital call, right? The investors will have to come up with money in order to reflate the property, reinflate the uh, the cash portion, the equity portion, and then they'll be able to get financing. Otherwise, they won't get financing. And that's what happened in 2007, 2008, when investors lost their shirt and the properties went back to the lender. So those are some of the protections in DST properties. And then the other thing is, in the DST properties, the loans are non-recourse to the investor. So even
Okay.
if an investor had $20 million of holdings in these DST properties and $20 million of debt, there will be no loan against their name on the credit report, because the sponsors never looked at their credit, never got their 1003 uh, form for getting them financing. So when people are trying to buy investment properties on their own, they have to find financing, they have to go through all the inspections, and sometimes these deals can fall apart. So then the other issue is the 45-day ID period under 1031 exchange. The 45-day ID period does not stop for anyone. It's a calendar 45 days, calendar days. What that means is weekends, holidays, uh, anything is covered under those 45 days. Whether there's Christmas coming, Thanksgiving coming, you don't get credit for those days. So once your clock starts ticking, the 45 days start to tick. And then once the 45 days are done, you cannot identify any more properties. And then your exchange is blown or busted, and you have to pay the tax. So investors have to be very, very careful if they want to preserve their hard earned money. They need to be aware of 1031 exchange first. And then with us, because we already have these properties with the due diligence done, with the prospectus available, uh, the properties under contract, acquired, operating, we can complete the entire 1031 exchange from identification to closing in 5 to 7 business days. So imagine if someone came in with 5 million in equity and we were getting them a, let's say, for example, 4% cash flow annual net in their pocket. That would be $200,000 of cash flow right away in terms of annual income. Now, if they were to go with a real estate agent or a real estate broker who could not find them another replacement property, number one, the exchange would be blown. And number two, if they took 180 days total to close, 45 days to identify, 135 days to close, they would have to wait for their money to work for 6 months. So
Right.
if they were earning 200,000 a year with us and they were waiting 6 months with the real estate broker, then they've lost $100,000 worth of cash flow in the 6 months it took them to close, right? I mean, that necessarily does not happen with the real estate broker or the real estate agent, to be fair to them. But all I'm saying is that from our side, we can complete the entire exchange from the identification to acquisition to the start of cash flow in 5 to 7 business days, which is huge because then your monthly checks start right away. So these properties are structured to be targeted to pay cash flow from day one. And that's the key to owning investment real estate.
Right.
Otherwise, otherwise, if investors are just doing it to be in real estate because their friend said that, their family said that, brother said that, cousin said that, uncle said that, and they're not getting any money, but then they may be just doing it for tax write-offs. I don't know. But just
Right.
something for a tax write-off, it doesn't make sense, because the only money that you get at the end of your tax cycle when you file your taxes after the tax write-off is whatever your net tax bracket is. So if your net tax bracket ended up 20% after all the write-offs, after the reduction in your tax brackets, you're literally getting 20 cents on the dollar back. You're not getting a $1 back on each dollar of deduction. So people, that's a miss. People people think that if they have $100 of tax deduction, they're getting $100 back. No, they're not getting $100 back. They Yes, it may reduce their tax bracket, but but that's for a CPA to discuss, or with their tax
Right.
to discuss with.
So
We don't
does
give.
your company focus on value add opportunities so you can implement like rubs or like parking, add like laundry, stuff like that to increase the value, or do you focus on a different type of strategy?
Yes, that's a good question. We don't do any value add, simply because, uh, number one, they're not class A. Number two, that requires a lot of capital investment. Number three, they're generally not giving enough cash flow up front. So the property types that we specialize in are, again, multifamily, class A, uh, usually 250 units to 350 unit apartments, in major employment centers around the country in all 50 states. Uh, and then some DST offerings may have two or three different apartment complexes, uh, in different states in one offering. Uh, then the next is essential retail. These are properties that were still open during the pandemic. So they're essentially recession proof, pandemic proof, economy proof. And these are your typical Walgreens, CVS's, Whole Foods, the grocery stores, uh, you know, Tractor Supply, uh, Home Depots, right? Costco's of the world, right?
Yeah. Something
Then
that can something that can stand like a recession or some kind of distress situation. It still stays alive, right? Like the
yes,
business. Okay.
still stays alive. Still, they're paying their leases, right? Cash flow is still coming, so the investors still get their money, right? So they tend to be on the safer side compared to a value add. And let's say you buy a value add office building, and people who did that 2 years ago, they're in a world of hurt because those office buildings are empty, most of them, anyways, right? But then the other investments are a medical office, right? Surgery centers,
Mhm.
they were open, right? People had to get surgery, they had to go see doctors. Uh, and there's commercial industrial warehouses, right? All these manufacturing companies and companies like Amazon, they were still operating, they were still in business, right? In fact, during the pandemic, all these companies that do business through the web, that business actually exploded. It increased
Right.
because people didn't want to go outside, right?
True.
So for the last mile delivery, those types of businesses are really great. Um, then there's also storage. Storage is another one that's great. It's an evergreen solution. A kid, graduates from college at age 21, 22, $500 worth of stuff, for example, puts it in the $100 a month storage and keeps it there for 30 years until it turns to dust. But they still kept paying the rent. So a lot of people will store items of lower value but high emotional value in these storage properties, and they may not worry about them and just keep paying the rent, and the maintenance is non-existent, right? Because there's no toilets or bathrooms to fix. There's no air conditioning or heating. All you have is a light bulb, and and the locks are provided by the tenant. So uh, the storage tends to be a good investment. So when people come to us, I tell them, look, first of all, don't focus on just one area, 30-mile radius, 100-mile radius from where you live. What if a hurricane hits in your area and you're wiped out? Tornado hits and you're completely wiped out. In California, what if there's a 9.0 earthquake and you're completely wiped out, right?
Right.
So nobody that I know has enough insurance to cover 100% of their losses, right? Very few people do. So it's better to diversify outside of their area where they live in different states, different geographic locations, different cities, different types of assets. So if one asset class is not performing, at least the other five are. So, for example, if somebody had come to us and said, "Hey, I really like office and I like these 100-story buildings," but if they had insisted on putting all their money in there, today they'll be hurting. But if they put only 20% of their assets in there and the remaining 80% in different multifamily, essential retail, storage, uh, then they would still have been okay. They would have not lost their shirt today, right?
Right. Right.
Uh, so
So like if you got a property and something like that happens, like a earthquake or whatever, like how would you implement an exit strategy to kind of protect the investors if something like that happened, or get your money back, something?
yeah, so like I said, real estate is an illiquid investment, number one. But if there was a uh, act of God or a disaster, a natural disaster, typically the sponsors put extremely good insurance on these properties. Uh, Income interruption insurance, property insurance, um, and not only that, they also protect the properties against any types of lawsuits. Like somebody gets murdered on the property, raped on the property owner gets automatically sued. So they'll put 50 million to $100 million umbrella uh, insurance policies on all the holdings, right? Together, they can do that if they have 15, 20 properties operating, right? Versus a smaller investor. Uh, so the insurances typically will cover that. Now, if they have to exit their property, for example, then in order to preserve their 1031 exchange, uh, their tax benefits, there's an exit called UPREIT. It's Section 721 exchange. So essentially, their 1031 assets can be exchanged via an UPREIT into a REIT, REIT, and that will preserve their tax benefits
Okay.
as long as it's structured right. But that happens pretty rarely. Now, some of our sponsors do that on a regular basis to offer the investors an exit strategy. So that was a great question because we have sponsors in the essential retail space who employ that regularly. And what they do is they'll get the essential retail properties and they have 10 to 15-year leases in place, right? So, but 5 years into the owning the property, then now the lease is only 10 years left or 5 years left, right? So then what they'll do is they'll acquire the property for their REIT. So they'll exchange the DST shares into the REIT shares, and the investor will preserve their tax benefits. And now they only pay tax as they liquidate the REIT shares. So essentially, they can, if it's a $4 million asset, $5 million asset, $1 million asset, and they're only taking $5,000 a year or $10,000 a year, they can essentially space out those taxes for the next 30, 40, 50 years, right? If they're taking out
Right.
amounts of money. because the only thing taxed on the monies they're taking out. So, so that strategy does exist, um, and it's a valuable strategy. So we do have very sophisticated sponsors and sophisticated investors. Now, again, when we use the term accredited, that necessarily does not make every investor sophisticated, for the reason that some investors, they just were investing in real estate because they didn't know anything better to do. They believed
Right.
in real estate. They somehow started investing when they were in their 20s. They loved it, and that's all they did. So they know everything about real estate, but they're not really necessarily sophisticated about the world, about stock investing and ETF investing, and shorting stocks, and all kinds of exotic strategies, right? Buying options.
Right.
So all they do is real estate, and actually that happens to be our primary source of business from people who are serial real estate investors, and they sell their properties. They've known about 1031 exchanges,
Mhm.
and then they come to us. And usually, the people who come to us are people who are in their 60s, who don't have time to engage in real estate management anymore. They want to
Mhm.
spend more time with their family, with the grandkids, travel the world, and do the things that they really love to do, and they had put off all these years because they were managing these properties by themselves.
Right.
Now
Are
they,
you able to, I got a question for you that's on my mind. Are you able to accept cash from like somebody that turned their 401k to a self-directed?
that's a good question. And now it's it's terrible. It's absolutely the worst option for someone to invest their 401k monies or self-directed IRA monies into real estate. And the reason is real estate is already tax favored. It's one of the best tax sheltered investments there is. So then the question is, why would you want to put an investment that's already tax sheltered, tax favored, even your current income is tax sheltered due to depreciation and write offs, right? The current income, and then make it all taxable. So if you had a 401k with worth $1 million, and now you come to me and say, Sid, I want to invest in DSTs. I want to, why would I want to do that? I mean, I already put a tax favored, the best tax sheltered investment there is by law, and now we put it in the qualified monies. Qualified monies means qualified to be taxed because you got an income tax deduction up front in the 401k and the IRAs. And now whatever happens to the DST properties, now instead of using the 1031 exchange, you got everything that's taxable. Everything. All the monies that you're going to get in the future as income are going to be taxable. So, absolutely, the answer is absolutely no. And if somebody
Okay.
tells you that they are recommending IRAs or 401ks as vehicles to hold real estate, please run away from them as far as possible. And I know a lot of real estate people are offering these types of strategies to investors that, look, put your IRA to use, put this to use. I just think that they happen to be misinformed. Maybe they're not aware of the tax consequences, but they are misinformed for sure.
Right, right. So I'm working on this deal right now. That's a tough one, man. And you seem you're really experienced in multifamily. There's this multifamily, a 264 unit in Beaumont, Texas. The seller's willing to just give me the keys, but the catch is they have a bridge loan that comes due in December. Is there a way to make that work?
Well, I mean, well, yeah, I mean, the thing is, you got to come up with monies for the bridge loan. So unless and until you get the keys and you can immediately refinance it, if there's enough equity in there, and then be able to pay off the bridge loan, then you may be able to get out of it. Or you can refinance it and pay off the bridge loan in the refinance. However, if you want to do it, that's really the only way I see it. Um, you know, I mean, there's got to be equity in the property. It doesn't really matter if he's trying to give you the keys. I mean, there's a reason why he's trying to give you the keys and not wanting any money from you. If I understood that right? He's not
Yeah,
wanting.
that's what was. It kind of sketched me out. Like I was wondering if he's just handing me over like a problem, like over some kind of problem, something I'm not seeing.
No, he's just handing you a bunch of problems. And I don't know if you're suited to cleaning, 500 toilets.
Right.
I mean, people say, "Oh, I'm going to sell the single family house and get a duplex." So now from a house, 2 toilets, you went to 4 toilets.
Right. So
If you, if
so
you,
so the
yeah,
the
go ahead.
strategy I use, I don't like toilets either. So the strategy I use, I usually use the subject to and then do a mortgage wraparound. So I'm the lender and then I don't have to focus on the toilets because the interest rates are so high right now. I take over the existing loan that's at a lower interest rate and then wrap it to what is it? Would it be called a penalty box buyer, right? Somebody that didn't qualify recently for a mortgage and then wrap it to them.
Right. Um,
But
yeah,
single family is small, compared to multifamily.
well, okay. So in terms of risk, here's the risk. If you own 5 single family homes and 3 of them are vacant, right?
Mhm.
That's 60% vacancy.
Mhm.
But if you're in a 300 unit multifamily investment for the same amount of money, right? And 10 apartments were vacant, right? That's like a 0.00, you know, 1%, right? It's just a
Right, right.
minuscule number. And it's not
You're
gonna
still getting cash flow. You're
and
not
you're still
out,
getting the same cash flow. It's
Mhm.
not affecting your cash flow, it's not affecting the quality of your life, and everything is done for you. Versus you're still dealing with tenants, toilets, trash, turnover, and trouble and termites, or you're paying 10% in management fees to someone who's trying to manage your property. So either you do it yourself or you pay a huge amount of money. And not only that, these professionally managed properties, they're charging 3-4%, 2-3% management fees because they are so huge and the amount of money is so huge that they charge very little amounts. They have their own plumber on staff, own electrician on staff. So it's not like you're paying a plumber, a $100 fee just to show his face to ring the doorbell. I mean, these guys have someone on staff for $50,000 a year or $100,000 a year in salary who's taking care of 300 apartments. So that's so when you go from 5 single family homes to a 300 unit apartments or 3 properties with 300 unit apartments each, 900 apartments, you get economies of scale, right? And you have huge reduction of risk. So people
Right.
need to understand the concept of risk. The smaller investments you're in, it's whether it's 2 or 3 or 4 or 10 single family homes or 5 apartments or 10 apartments or 20 apartments. In 10 apartments, if 3 apartments are vacant, you got 30% vacancy. And by the way, most lenders will qualify you for a mortgage with a 30% vacancy factor. And the loan may be in your name. It may be recourse, right? At least single family and 1 to 4, they will be recourse. So uh, essentially, you're going from a smaller, uh, all risk type of model, high risk type of model, to a low risk, you know, uh, efficient model, right? But again, look, by going from a single family or duplex or a fourplex going into a DST 300 unit apartments, the risks don't go away completely. What people need to understand is if they're going to be doing any kind of investment, there is risk, right? They have to understand that. Whether the risks are disclosed in a 300-page prospectus, which we do, or they're not disclosed when they buy a single family home, the risk is still there, of the investment risk, right?
Right.
So if somebody does not want to take any risk, they're better off with their money in the bank or US treasuries or, you know, something that gives them, like in a bank CD or a money market account, 24/7 access, use your debit card online, you know,
Yeah.
and you can take monies, right? Stocks, you can liquidate them in 3 days, 3 business days, you can take out your monies once the trade settles, right?
Right.
Uh, but in real estate, the inherent risk is that it's illiquid, it's an illiquid asset, and you should expect to be invested in it for at least 8 to 10 years minimum.
Right.
But the investment cycles, you know, they are just longer. And the other thing that is good with DST properties is, let's say if the holding is in a trust and you pass away, your family does not have to fight over the assets, whether to sell it, not sell it, what to do, what not to do. And that's
That
really good.
bypasses probate, right? That when it's in a trust, it stops the probate, right? It just goes straight to the.
Yeah, it bypasses probate, and the property stays in the name of the trust. The monies keep coming in the name of the trust, the same checking account, and the heirs get the distribution from there. So it's as if nothing else happened. So it's a great
Right.
estate planning tool as well.
Right.
Versus owning these 10 single family homes or 30, 40 apartments on your own. Now someone has to sell them, or someone decides not to sell them. And in California, we have Proposition 19, in which anytime somebody passes away, all their investment properties will be retaxed at market value versus what they had before. So the tax basis will not be carried forward. It's going to be the new tax basis unless and until the heirs decides to live in that property. So they can live in their home, their parents' home, or but they can't live in the shopping center. They can't live in the office building.
Right.
They can't live in it in all 40 apartments. So it's a tough situation that California investors are in.
Right. So when it's a multifamily, I know in single family, like a lot of my buddies, they're having problems with squatters, like getting people out, and they have to keep the water on. Is it different with multifamily, or is it the same in like California and like New Jersey and stuff like that?
Yeah, in multifamily institutional quality class A, they really don't have those types of problems where people are not paying rent or squatters, uh, because typically these are high-end apartments. These are people who are, look, during the pandemic, class C, class D apartments, the rent collections were in the 40-50% range. And a lot of owners had to go into default, uh, or the properties went back to the lender because they couldn't pay the mortgage anymore. But from what I understand in the market, the Class A properties still the rent collections were in the 92 to 95% range. So they really didn't have that type of distress that uh, the value add. See, value add is code for that this property is in the dumps, and you got to do everything to bring it up to code, and it's make it livable, and invest your monies either sweat equity, right?
Mhm.
If you're young, yeah, and you got some cash on the side, you can do it, and people do it, and people do flip it. So that's another way to make a living buying and selling real estate. right? Or buying a property that's needs to be rehabbed, you bring it up to a livable standard, and then
Right.
you lease it out. And if you do that again and again over 10, 20, 30 years, you can accumulate a sizable amount of real estate, you know, and that's awesome if someone can do it. But our types of DST properties are fully mature, class A, and they are really good for investors who've done it all, seen it all, broken their fingernails, gotten their hands dirty, dealt with squatters, tried to evict people, not got rent for 3, 4 months, essentially were putting all their monies into maintaining their properties and taking those phone calls during Christmas dinner. So those are the type of people that do end up coming in our properties, serial real estate investors or real estate brokers for the most part, and doctors and lawyers and accountants and people who are high net worth investors who want their money to make money for them, right?
Right.
And they don't have time to deal with all this stuff themselves. And now they want to enjoy their life. Uh, but
And
again,
just get that mailbox money, right? Get the mailbox money coming in every month. And,
yes, mailbox money, as long as the property is operating at full occupancy, you know, um, and 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 then they're acquired at a very good cap rate, with at least 2.5 to 3, debt service coverage ratio. So these properties already have cash flow. They're already profitable upfront. They're already paying you cash flow mailbox monies every month. And those are the properties to invest in as long as you have a minimum $100,000 to invest per property. So
right.
for a lot of investors who are starting out in real estate, they shouldn't be discouraged to hear what I'm saying here today and saying, well, you got to have $100,000. You need to be accredited. You know, you don't need to be accredited, and you don't need to have $100,000 to get started in real estate.
Right.
You can go out and acquire properties in many different areas in our country with $10,000 down or $20,000
Yeah.
down, and
So
you know
I have this. So my mentor, Pace Morby, he has a fund. I was always curious how he set it up. Like I know how you got to be an accredited investor, right? He set it up where you don't have to be an accredited, and you can put a minimum of 1,000, and it's for multifamily, but he can only raise a certain amount. I don't know what the cap was. I don't understand how he set that up.
I am not familiar with that structure. There are many structures that many different sponsors or people who set up these investments are doing. There are many different online forums where you can invest $100 per property or $1,000 per property, whether it's residential or commercial. So uh, people who do not have the minimum $100,000 to invest in a DST type of property, or do not have generational real estate, uh, they should definitely look into it. But the idea is to get started today. The idea
Right.
is to pay yourself first. So whatever business you're in, whatever job you do, you know, look, you always pay the doctor through health insurance. Uh, auto insurance, you pay for the auto insurance, and then you pay the mechanic if your car breaks down, right? So the investments, life insurance is something that your family gets paid if something happens to you, or if it's a cash value, you can use it, right? You can use it for emergencies, or if you have terminal diseases, you can access monies up front. Uh, Same thing with real estate, mutual funds, REITs. So if somebody has only $500 to invest and they have a stock brokerage account, they can invest in REITs online or through their broker. However, or through their bank, they can go to the local bank and talk to the investment advisor there. So there are many different ways to get started, but the winners in life are the only people who got started today or yesterday, not tomorrow, not day after, and not kept thinking about it. Or see, analysis leads to paralysis, right?
Yep.
So the key is when you bring your paycheck home after deductions at work, maximize your 401k, right? Your retirement plan. That's the best investment there is for retirement for long term. And then from the take home income, save at least 10 to 20% of the monies, right? And once you put it on automatic deductions on a monthly, uh, you got cost averaging as well, right? You just do automatic through your checking account and just deduct it every month from your take home balance. So whatever the balance in the checkbook is, and you're investing $300 a month, you deduct the $300 first, and now let's say you have $2,500 left in your checking. That's what you spend, right? And then don't try to take too much. Don't try to buy too much on credit, because that's going to kill you from the interest rates. They're very, very
Right.
high interest rates. So the idea is to save first, spend later, pay yourself first, and then pay others later, right? And then also be able to pay off your credit card in full each month and not take on any more new expenses until and unless you know that you have money in the bank. Or if somebody cannot handle credit properly, if they're tempted too much, then just use a debit card. That's the best way. Because you go
Right.
and you want to buy that beautiful pair of shoes that you just saw, and you gotta have it. Well, you use your credit debit card and you got 2,500 in the bank and the shoes cost 300. Sure, you can get it, right? But if you have 295 in the bank and the shoes cost 300, guess what? The debit card is going to get declined. You're not going to be able to buy it. So so but if you live a financially responsible life, you can build great wealth. But the idea is to get started, whether you're going to be investing in single family homes, in apartments, in whatever you're going to do, but it's got to be methodical. You got to pay yourself first. You got to save first, spend later, maximize your tax deductions that the IRS allows. See, the wealthy people in this country, with all the tax deductions that IRS allows, they pay between 1 to 5% in taxes. Most people pay 15 to 30% in taxes of their income. So are the wealthy people different than us? Well, in one way they are, because they're maximizing the legal tax deductions allowed by law. And that's what we should be doing as well, right? So we have to live within our means, and that's the key. That's a
Right.
responsible way of living, and you'll feel good about it. If you live debt free, you'll feel good about it. If you have certain amount of monies in the bank, and you got to have at least 12 months of living expenses saved in the bank first before you start, putting monies everywhere, right? 12 months of expenses, because that, if you get laid off, right? If you're working in a job and they're harassing you, or they're making you work past your 8 hours and not paying you overtime, and you're scared to leave, you can definitely make moves if you know you have monies in the background. You have 1 year's worth of living expenses, your apartment rent or your mortgage, and your expenses, right, to back you up. And you can make different plans. You can move to another area of the country, you can get another job, whatever you need to do, but that gives you flexibility, right? So So the winners in life are the people who follow a responsible financial strategy, and also talk to your local financial planner if you cannot do these things by yourself, right? Talk to
Right.
the financial advisor in the bank, right? You'll get some pointers there. Talk to your local life insurance agent. Get your life insurance planning done. If you are married, if you have children, if you have family that depends on you, right? So,
I had two questions that are pretty good questions.
yes,
So one I was gonna ask, like, so let's say you get an apartment. It's got 200 units and it's got regular tenants right now, right? Just like long-term rental. Can you convert it to a sober living and charge per bedroom to increase it?
it depends on your local laws. I mean, see, there is student housing, and in student housing, it's very common to have two bedrooms to an apart. I mean, two bedrooms, two beds per room, right? So they'll convert from one bed to a room to two bed to a room to increase their revenues. So that is doable, but again, depends on your local laws and the ordinances. Um,
Right.
Depends on you know, if it's a rent control apartment, or so you gotta check with your local city ordinances before
Okay.
you embark on any of those strategies. There's also condo conversion. You if you have an apartment complex, if you want to convert that to condos, so there's a process for that. But check with your city. Uh, those may be great ways to increase your revenue and your profits, right? See,
Right.
profit is not a dirty word. We're all in the business to make a profit, right? That's why we are entrepreneurs. That's why we take investment risks, right? Otherwise, why would anybody want to take a risk? They would just put their money in the bank and sleep, you know,
Right.
go to work, put
True.
the money in the bank, and that's it.
Let's say somebody doesn't want to set up their own fund, but they're getting a lot of lead flow, like acquisitions going crazy. They get a lot of lead flow. Would they be able to partner with you? Let's say they got a deal and it's a killer deal, but they don't have access to raise the capital for it. Would you like do some kind of equity thing where I want a chunk of the equity and I'll help you raise the capital, or is that even a thing?
Well, you can work with us to bring investors into our offerings. Um, we could work together. Um, you could do the marketing end of it, and then we'll just pay you per lead. Uh,
So like somebody that is like an accredited investor, per se.
that's well, at the very minimum, they will have to be accredited investors to be able to invest, right? So you can work as a marketing company for us on a regular basis, and that's what you do, just lead generation, because you have this investor flow who are looking to invest in real
Mhm.
estate, and that would be the best way to structure this. Now, if you were to share in the commissions, then you would have to be securities licensed with all the
Okay.
different securities licenses, continuing education, the fees, and everything that goes with it. Just as you have to be real estate licensed in order to earn real estate commissions. So we
Right.
can't pay you any commissions per se, but
Hmm.
we can definitely work with you, and
Like
compensate.
how would you set that up? Is it like a portal, like a back office, like where I send them to like a white label, I guess per se, or how would that work? Like how would we track it?
Well, I mean, it's the way it is set up right now is you email us the leads, right? And then uh, then we track it, so we update you on all the conversations with the investor, and that way you are part of uh, uh, the link, and you know.
Gotcha. That makes sense. That makes sense. So just like CC the lead, the client.
Yeah, and also you could always call the client. You could always call the investor. You know, it's not like you're going to have 1,000 leads a month that you can't really keep up, right? Uh, but then, from our perspective, we will definitely pay you per per lead that converts in that sense. Uh, uh, and if you're doing good marketing for us and bringing us good leads, then why would we not want to keep you in the loop and maintain that business relationship, uh, you know and on a transparent basis. But the best way, I think, is to just CC you on any leads that convert, so you know as to how the deals are getting done. you know
That makes sense. And y'all have your own acquisition department, right?
well, my role is that of a broker, so I don't
Gotcha.
particularly have my acquisition department, but each sponsor, they can have anywhere from 30 employees to 300, 400 employees, depending on their size. And their acquisition departments can be huge. They have accountants, attorneys on staff, uh, you know or they can consult with attorneys, and they have their acquisitions people, CFOs who look at the numbers. They if it's an existing building 2 years old, let's say, or 3 years old, they look at 2 years trailing bank statements, verify all the deposits that are coming in, tax returns of the seller. So they'll do all the due diligence, which a regular investor may not be able to do or get that type of information from a seller
Right.
or
Right.
through a real estate agent. So they just do the due diligence on a very high level, and they verify every single thing that the selling broker has told them or has alluded to in the prospectus, the many prospectus that they offer. So they're well researched, well thought out, uh, all due diligence done, all inspections done. They have to pass all the inspections, compliance with state law, city, permits. So they look at every, dot the I's, cross the T's. And for every, I would imagine, every 15, 20 properties, 25 properties that they look at, they'll eventually acquire one. And then the deal has to make sense. See,
Right. Of course. Of course. Yeah.
I mean, our sponsors are still getting loans at 4 to 5% range for a $50 million loan, right? And our sponsors are still getting, loans in the 4 to 5% range on a 40, $50 million loan. And if you were to go talk to the average investor looking for a loan on their single family or a duplex, they're probably going to pay 8, 8.5 on a non-owner occupied property. So
Right.
there's a huge divergence between a, a smaller investor trying to do things on their own versus an institutional investor who's,
Like a hedge fund or something. Hedge fund or.
yeah, I mean, essentially hedge funds, private equity, insurance companies, banks, right? Retirement funds.
So the reason I was asking, sorry, I had to plug this up. Reason I was asking about the acquisition thing is, let's say in my community I see an off market. One of my team members found, I'm just for saying, an off market something that meets your buy box, and it's off market. It's not listed. Would you be interested in looking at that? Like looking at something that's not listed, and but the seller raised their hand, they're willing to sell.
Yes, the answer is yes. I particularly wouldn't do that type of due diligence, but we could definitely connect you. with our sponsors, as long as the property is Class A. It's a slightly large project, like you said, 250, 300 unit apartments, and especially if they're brand new or just being built for that matter, um, or maybe 2 years old and then fully leased. So those types of projects, especially the ones that are sort of brand new and fully leased, are the ones that would be the most interest to our sponsors. And also in the deal where they could make money for their investors on day one. So the cap rates that your seller will have to offer would at least be should be higher than what they would, you know, expect, right?
Right.
Because
That makes sense.
yeah, because they can make the deal happen, right? Because if the apartment complex are asking $50 million, there's not a lot of buyers who can come up with that kind of money or financing, right? 25
Right.
equity, 25 million debt, right? 50% loan to value. So, uh, so that's the other thing, that our sponsors, they can make these deals happen. So absolutely, you'll get a finder's fee most likely from the sponsors. Um, but I would be happy to refer you, and then whatever your understanding is with the sponsors, that work with them directly. You know.
Do y'all buy just cash, or like, let's say they're trying to do an assumable loan? Do y'all do creative, or is it just cash? And what markets wouldn't y'all touch? Just so I can niche it down for you guys.
The sometimes the deals that our sponsors put, and by the way, they're all off-market deals. They're not listed publicly, uh, um, because we cannot advertise them. So the 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 uh, the, the deals are sometimes all cash. They don't put any debt on it, right? So as the investor equity comes in, um, the bridge loan gets retired, right? And it's all cash, so there's no risk for a new investor that's coming in, right? Um, so that is done, and then the markets that they're interested in. I mean, I'm seeing a lot of deals in Texas, in Florida, in Nevada, in Virginia, in the Carolinas, in the Washington D.C. area, um,
Right.
or any like Chicago.
I have several storage units right now, but they're not really big markets. They're like Livingston, Lufkin, Texas. They're not really metro.
Yeah, look, the areas that our sponsors look for are areas that are usually near or in the major metropolitan areas, with growing employment, with growing industry, new companies coming in that will generate new employment. Um, they generally try to stay away from the army bases, or the ports and that kind of thing, because the army bases can go away, right? So in that case, a 500 unit apartment complex near an army base, now it's fully leased, but as soon as the army base gets closed down, now they're stuck. So they
Makes
won't
sense.
have places like that, but a regular area where uh, there's a diverse population mix that's coming in, and also people migrating to that area from other areas in the country, right? So those
Got
are
you.
areas that are of interest, because there also the sponsors have the ability to increase rents on a regular basis, right? Oh, and by the way, not only the sponsors have a very sophisticated tool at most of their properties. They use modern software technology to to calculate rents on even an hourly basis or minute by minute.
Really?
Yes. So if a tenant came in at 10:30 in the morning, for a two-bedroom apartment, it's going to be one price. But if they came at 1 o'clock in the afternoon, it's going to be another price, and at 5 it's going to be another price. So they better put their deposit down, uh, when they're ready to do it. So because the pricing is variable and it depends on market conditions according to the communities nearby, that whole area, uh, the major news of the day. So they're using algorithms to predict rents in that area for that minute of the day,
That's
which
cool,
is
man.
amazing. Yeah. So they control their own destiny, which is what I like with multifamily. And
But
in my view, multifamily is probably the most stable investment because people need to live somewhere. They need to have a roof over their head. Um, and then the other is like grocery. People need to eat food, buy stuff. Unless into the grocery store really screws up and there's poisoning and whatever, and you imagine the worst case scenarios, and they go bankrupt. That's a different issue. But usually they're very very stable. You know.
right, you know how you brought up you want to know where people are going. My buddy just showed me this kind of cool tool from U-Haul. It's a migration tool, so you can go in there and get the report, and it shows where most people are going with the U-Hauls,
Yes.
so you know where they're going. It's kind of cool.
Yeah. Yeah. I mean, U-Haul is a great predictor for business growth. I mean, the numbers from FedEx or UPS can also tell you which areas of the country are growing, where there's more business activity. Airlines are a very good predictor. I'm pretty sure those types of numbers are integrated in these algorithms to predict the pricing and how they acquire these types of properties in any given areas. And not only that,
Right.
all this research is given in the prospectuses as well. So they give you all this material information that's important to the acquisition of the property, you know, which is fantastic. They'll give you and if you ask, they'll give you the appraisal numbers, uh, and all the numbers, cash flow numbers, scheduled gross income, all the expenses, uh, projected expenses as well, net operating income, uh, net cash flow. Everything is given to you upfront.
Is this a paid tool, or like how can you access that? That sounds way advanced.
It's Yeah, it is, and it's absolutely uh, uh, necessary, and it's included in the offering. So whenever we talk with an accredited investor, we have to include that prospectus by law. So we have to include that. So we will give it to them at no cost upfront. No, no, we don't require any type of a confidentiality agreement, nothing like that. If you go to a real estate broker and you want some information about a 200 unit apartment complex, they'll make you sign a confidentiality agreement.
Right.
That okay, and then if you want to get any more information on the bank statements and whatever, they'll say, oh, you know what, you need to make an offer and make the acquisition contingent upon getting all this information in your due diligence period. Well, guess what, we
Right.
have our sponsors have done all the due diligence. When I say the word we meaning our sponsors, not me
Right.
personally, right? My broker dealer
So
also.
for viewers that don't understand, what's the difference between a sponsor, a GP, and an LP? Just so people understand
a,
the
a,
difference.
yeah, a sponsor is someone who's like a syndicator who syndicates these properties, puts them all together, right? And then
Mhm.
brings them to the accredited investors, right? And they're usually offered on a private basis to investors through brokers like me who are
Mhm.
security licensed, right? Now, a GP is a general partner who takes all the risks in a partnership so that the risks of the limited partners, the LPs, the limited partners, is transferred to the general partner. The general partner says, look, I'm going to manage this investment for you. I'm going to assume all the risks on your behalf, right? And they'll probably have errors and omissions insurance and all kinds of insurances. But the GP is the one that said, look, I'm going to do everything in this property and you're limited partners. So you don't necessarily have to do anything. And I'm gonna be the decision maker, right?
So it's more like they're the passive, just passive
Yeah. So
investors.
both, so the sponsor is also allowing for a passive investment. A general partner is also allowing for a passive investment, though they may have input from limited partners, right? So, however it's structured on the general partnership side or limited partnership side, and the general partner they will send out a K1, a tax form, which reports all the taxes, the profits and losses to to the limited partners, the investors, at the end of each tax year. So the investors in a partnership get K1s. The investors in a DST property, a Delaware statutory trust, they get an operating statement. We don't do any reporting directly to the IRS. Your tax person or you or your tax attorney takes the numbers from the DST, right? Your proportionate numbers proportionate to your investment, and then they can plug in those numbers in your Schedule E, in your tax.
I like it, man.
I'm not a tax person, nor I'm an attorney, so I don't give tax advice or legal advice.
You had to do that disclaimer, man.
Yeah. I mean, whatever we are discussing is incidental to our profession.
Right.
Yeah.
Love it, man. So what do you got planned for the future, man? Where do you see yourself 2 years from now, man?
Well, I
What are
mean,
you trying to accomplish? Like, what are you trying to accomplish next year, like to next year or whatever?
well, look, as far as work goes or profession goes, I love all things real estate. Like I love your title, everything real estate. So that's really what I am all about. And I'm engaged in all sorts of real estate from A to Z. But this is the major portion of my practice. So this is for the real estate part, but the higher purpose in life for me, uh, whether it's next year or the year after or for the next 20 years for as long as I live, is to serve others, to serve humanity, and to do community service projects worldwide. I have been doing these community service projects since 1988, for the last 35 years. And we've gone out to different countries. When I was younger, I was traveling to different countries and participating in these projects, uh, which are, they have an exchange uh, of people's beliefs, what they believe in. There's a community service aspect of it, and then there's a cultural aspect of it. So we try to understand each other through these interactions and work shoulder to shoulder in uplifting a community, whether it's to build a community service center, uh, a daycare center, whether it's to put a water well, source of clean drinking water, to install solar, whatever it might be. So those are the types of projects. In 2017, I started a foundation called Global Youth Service Foundation. It's The website is GYS as in Sam, F as in Frank, N as in Nancy, P as in
What was the last letter?
P as in Paul,
Okay.
GYSFNP.
If you drop the website in the comment section, I don't know if you see it on here. I can actually highlight it on the screen if you want me to,
Oh,
like on the comment
the
section.
chat. Yeah, chat.
Yep.
Okay. GYSFNP.org. So that's the website for the nonprofit where people can go and donate. We have been doing projects through that each year since 2017. So far, we've done projects in Sri Lanka and India in disadvantaged communities, um, and have provided, clean drinking water. Uh, in one area, we our participants, they built a small bridge over a stream, so the villagers who were cut off from the rest of the world could work, could interact with the rest of the world, sell their products, get whatever they needed. The kids could go to school. So it's a worthwhile effort,
That's
and
awesome, man.
yeah, and I love doing that, and that's really, if I was to ever retire, that's pretty much what I would do full time, uh, community service, and on a local basis, I work with the local church, the local mosque, the local uh, the Jewish synagogue, the local temple. Look, I go wherever there's like-minded people who want to help other people.
Right, right. I
So
like that.
yeah, I think when people walk around with labels, that causes more conflict than friendship, right? So if we were more understanding of each other and try to look for the best in each other, try to learn the best from each other, that's what matters. It's not, you have to stop pointing fingers at each other. Stop saying that, hey, you did that wrong, you did this wrong. Because you know what? If you point one finger, there's four fingers pointing back at you, right?
Right.
If you know, throw a stone at someone, they'll throw 500 stones back at you, right? So might as well learn the best. No one is perfect. I'm not perfect, right? No one was perfect ever, you know. Uh, so
But I agree with you. Like like you want to hang around like-minded people because I believe if the five people you hang around, some's who you really are, and like traits will rub off on you. So like if you hang around some broke people that are toxic, you're not gonna be a millionaire because they're, you know what I mean. It's kind of like that's what I believe, right?
yeah. I mean, hey, look, if somebody is a really nice person, but they have a drug habit, then I would essentially not try to hang out with them because, you know, I just don't want to try drugs. You know, if that person say, "Hey, do this, do this, do this," um, or what I would do though is I would say, "Hey, look, man, you need to go into rehab, right? Try to do that. Try to counsel them, right? If they're having depressing thoughts, suicidal thoughts, I say, hey, this is the suicide hotline. Call this." So I would try to
Right.
help that way, right? But they may also have some good things to offer, right? So just take their good things, but leave whatever is not necessary behind. So look for the best in each person, in each religion, each person's way of life, each neighbor, and just help other people without prejudice. You got to live in harmony, and that's the
Right.
message. Uh, we have so much conflict in the world today, and it's not necessary. I mean, if you're going to have 1,000-year war and you're going to kill each other, uh, it's just going to continue. It's not going to stop, right?
Right.
So at some point, people have to say that, regardless of the side they're on, that look, this killing has to stop. We have to live in peace, and let's just give each other what's due to each other, right? Every person has a
Right.
right to live. Every country has a right to exist. People have a right to exist. People have a right to live, but all peoples have a right to live, not just some people, right?
True.
So that's where it ends, right? You don't necessarily support one over the other, and uh, but of course, we cannot support killing. We cannot support countries that are illegally trying to take other countries, right? So whether it's the Russia-Ukraine conflict or the Israel and the Hamas conflict, uh, there's just so many uh, people just need to have more understanding of each other. And I think when they interact with each other, when they do community service projects with each other, they meet with each other, they exchange ideas, people will discover that most faiths, most ways of life are really saying the same thing, right? Literally every religion or every form of thought is saying, love thy neighbor, right? Do good to others. If you do good to others, good will come to you. So there's nothing really different in any form of life or form of thought, right? So, I mean, I go to church, I go to the Gurdwara, I go to the temple, I go to a mosque, I go to synagogue, but they're all beautiful people because they want to serve others. And that's why I go there, right? So I think uh, in our country, we need to stop putting labels on each other and stop pointing fingers.
Right. Take accountability, right?
Yeah, it's accountability, and most of above all, it's your self accountability, self responsibility, right? We got to be accountable to ourselves. We got to look at you first, at yourself first, and say, okay, what am I doing? What am I contributing to society to make it better? What are my children doing for the society to make it better? What are we contributing to the world, right? That's how you bring up your children. That's what I've been telling my children. That look, all you need in life is two pairs of clothes, one pair of shoes, one bed to sleep in, two meals a day. As long as you have that, you're okay, you know, and you have a roof over your head, you're okay, you know. And then whatever money you make, just help others, you know.
Help others. Yep. Have to
Yeah,
have a go giving mentality, right? Like
yeah,
help people. Like
help
for
people.
example, like for single family, like there's the list foreclosures, right? And all these wholesalers will hit them up just preying on these people instead of like giving them options like loan modification, like actually trying to help the seller, right? It's crazy. They just try to take advantage of certain people too, you know.
Well, yeah, I mean, and that's why the laws changed after 2008, because there were a lot of predatory loans, the negative amortization loans, where they put people in homes for 1% loan, but the rest of the interest was getting added back to the mortgage, and most of those people ended up losing their homes. So uh, yeah, I mean, that can happen. A lot of lenders, they went under because of that. A lot of banks got fined billions and billions of dollars for these toxic mortgages. And the whole financial crisis was because of that. So uh, the unfortunate part is that when you have 3-year fixed mortgages, 1-year fixed, 5-year fixed, those loans come due. And then at the time of renewal, if the rates are really high, uh, then that can put really a lot of people in a world of hurt, because they got the loan, the short-term loan, because they couldn't qualify for a 30-year fixed most of the time, right? Um, or they thought that they would be in a property for only 5 years and they got a 5-year fixed. But then things change and now they want to stay there. But now instead of a 3% loan, now the new loan is at 7% or 8%. So
Right.
then they can't afford it, and then they have to let the property go. Um, so that's just a very tough place to be in. Um, but I think, in my view, a 30-year fixed loan is probably the best. in terms of financial security and for the purpose of holding an investment. Um, or if an investor has discipline, then an interest-only loan may be also good. A lot of lenders are offering 40-year fixed loans, 10-year interest only, 30-year fixed thereafter. But if they get an interest-only loan to maximize their cash flow, and then they have the discipline to sell the property in 7 to 8 years, then that can work in their favor. But then the issue is the market still going to be good when they're trying to sell, right? So
Right.
if the market drops like it did drop now, and your local real estate is down 20%, then you're back to whatever you bought it 7, 8 years ago. So then that can really hurt you. So there's a lot of risk, but you can definitely pay off your loan early if it's an interest only loan, and you pay the same amount as if you were paying a 30-year fixed mortgage. So the extra monies that you pay, it goes towards the principal and gets the principal reduced faster compared to a 30-year fixed uh, mortgage.
That makes
Those
sense.
tables, yeah, the 30-year fixed mortgage table is not linear. If the amortization table is they they charge you the maximum interest in the first 10 years of the loan. So if you look at the table, the mortgage schedule, you'll see that very little money is going to pay down the principal. But that's designed, however they came up with that. But most lenders know that people don't want to stay in a house for in 5 to 7 years. They're thinking of moving, and they end up paying a lot of money. So then the question is, do you get a 5-year fixed mortgage, 7-year fixed mortgage, 10-year fixed mortgage versus a 30? You know, so but if
True.
somebody wanted to sleep well at night, I would still say 30. I would still err on the side of caution. So if your plans change and you decided to stay in that area because now you put down roots, your kids love that area, you love that area, then you're okay. In 30 years, the mortgage will be paid off.
Right.
So, that
Let's
that's
let's say
yeah, go ahead.
no, proceed. Sorry, brother. I didn't mean to. You
Yeah,
can go.
no, I was comparing these different loans. The 30-year fixed loan made a lot of sense when uh, in all the way until 2020, 2021, all the way up to November, December of 2021, the rates were still in the low twos and threes, and you could still get a 30-year fixed mortgage at 3%. Then it made sense to get a mortgage at 3%. But then a lot of people opted to get a 5-year fixed for 2%, right? Or 2.5%. And I think that was a mistake because now those same people are going to be paying 6, 7%. And they'll end up
Great.
doing another fix because now they don't want to do another short-term 3, 5 year fixed because they can't afford a 30-year fixed at 8%. So so they're always chasing the 8 ball.
So like back to the syndication thing, right? Let's say like an accredited investor wires the money or decides to invest. Do they get put into like a follow-up thing where you keep them updated about what's going on with the property? And like when you purchase it, do you like do a like an event at the property where the main investors can go and be a part of it and like see it, I guess?
Great question. Yes. Answer is yes. They can go on due diligence tours. We can arrange that. The investor can book a flight, book a hotel, show up at the property, and the property manager would be delighted to give them a tour. We actually recommend and encourage our investors to go visit every single property that they're going to invest in. I think that's a very important part of their own due diligence is to go and see exactly where the property is located, what's the neighborhood, what are the feeders coming in, freeways, the location, right? What kind of property it is. And you can only get that from being there, right? That's a 360 degrees experience, which you cannot get by any amount of videos or prospectuses or anything. So that's number one. Number two, as far as reports go, yes, they get quarterly reports and they get annual reports. And at the end of the year, they also get the operating statement, which they can take to their tax professional, who can help to report the income and all the tax numbers. So
Love
yeah,
it.
yeah. I mean, it's very very professional. It's highly organized. It's unlike anything that you will see in your personal investing or investing through a realtor or a real estate broker, because they're simply not equipped to do that. They're highly transactional, right? But you say, okay, Mr. Broker or realtor, I want to buy a property, and they'll say, okay, what type of property are you looking for? I'm looking for a fourplex, and they'll go look for fourplexes and what area, the area you mentioned, and then they'll find you a fourplex, you like that, and they'll sell it to you, and they're done. They're out of there, right? They're not giving you reports. They're not managing it for you. They're not. So now, if you have a property manager there who you're paying a fee to, then they'll be managing it for you and they'll give you the numbers. But most of the time, even they won't give you quarterly report. They'll give you annual reports. So, but with our sponsors, they do give you quarterly reports, annual reports. They tell you exactly what's going on with the property. So, for instance, sometimes a property, there's a hurricane, right? And then there's
Right.
some damage on the property, right? They'll immediately have a conference call for all the investors, update them as to what's happening, what the damage is, what the costs are going to be, what's going to be the impact on cash flow, right? Um, and then they'll say, okay, we think the impact is going to be for the next 6 months on your cash flow. From 5%, we'll be able to pay you only 3%, right? So the investors understand what's going on, right? And
Right.
the and then we expect the cash flow to be restored once this additional expense is taken care of, and once we get insurance monies reimbursed, right? Uh, and the impact that it had on the occupancy, because those apartments could not be rented. And now, once we get back to the occupancy, then we'll be able to restore the cash flow. So, all of those conversations and reports are going on. It's an active basis. So, they're actively managing the property, they're actively informing you as to what's going on. And it's just a great way to invest in real estate and get passive income. At
Right.
the same time, being informed, at the same time getting all the due diligence, and then when the property sells, then we have other properties in our pipeline which are available for the investors, either through the same sponsor or through different sponsors. We have a
Do you feel like majority of the time an investor that invested in a deal prior, they'll jump on the new opportunities, or do they wait a little bit, or do they jump on stuff like right away?
no, they have to jump on stuff right away because of the 1031 exchange rules. So you have 45 days to identify and 135 days to close, for a total of 180 days. So as soon as they close in another DST property through us, their income starts right away, their cash flow starts right away. So for our investors, they're income oriented, they're cash flow oriented, right? So the sooner the cash flow starts, the better off they are. So they actually love it when their property sold today on November 17th, and on November 25th, excluding the weekends, in 4 to 5 business days, we put them in this other property with all the paperwork that needed to be done, and the cash flow starts again, prorated to that date. From November 25th to the 30th, the 5 days of cash flow will be prorated. And then for the month of December, the cash flow will be, income will be paid in January, right?
Okay.
So, so it's very, very uh, professional, and it's managed very well.
I love it, man. So let's say you find some investors that raise their hand. I'm interested in investing. Do you like create like a registration Zoom about that asset and have all the investors come in at once and you pitch it to them like a pitch deck or something? Or how do you do that part? Like, how do you handle that?
Well, we don't, pitch like one property, because if you were to just promote one property, then it might lead to accusations from a potential investor about some hidden conflict of interest, or uh, that we were going to be paid more to promote that property versus other properties in our portfolio to promote that particular property to the investor. So we really don't like to do that. Uh, and also from a point of uh, diversifying risk, that's not a very good idea to just show one property. So let's say we have 30 properties in our portfolio at any given time. So we put them on a spreadsheet, and have a small analysis on each property, right, in the spreadsheet. And then on top of that, we'll give hyperlinks to each property to the prospectus, where it'll have an executive summary, usually inside the prospectus, or we can parse it and we can give them executive summaries on each property separately if it is available. And then we'll present them the whole menu of different properties and have a discussion on risk, have a discussion of what their likes are, what they want to do, uh, whether they like, some people will say, all I like is Texas, and all I want to do is properties in Texas, right? So then you're kind of limited, because now if you have only two properties in Texas and that's all they want, then it's their choice. Then they're in the driver's seat. So we'll notate their account that we showed them all the properties. We gave them the choice to pick from all these different properties, but they chose these two properties in Texas, and that's okay, right? Because the investor wanted to do that. But
Right.
now, let's say the investor tells me that they are very they don't like to take risk, in the sense that uh, they want lower type of investment, right? And then when I show them the multifamily property, apartments, shopping centers, and maybe there's an office, and they say, "Oh my God, I love that building! 100-story building, beautiful tower, and I want to invest in that, and I want to put all my money in that." Now, office is the most aggressive portion of the investment. I mean, usually the land is the most aggressive, because it's not paying you any cash flow, usually, for the most part, right? It's just a very long-term investment.
Right. You got to get entitlements and all kinds of stuff.
Yeah, I mean, there might be illegal squatters on there, whoever, right? Whatever. So land can be a dangerous investment from that part, that perspective. So if I'm saying that, look, I really think that you should be going into multifamily properties, right? And the investor is insisting on going into office, so that's a conflict right there. That property is not suitable for them.
That
But
makes sense.
yeah, but if they insist, then I really have to notate their account that, look, uh, the investor invested in this property against our advice. Um, And in some cases, we may even have to decline the investment, because if the investor is really out of control and it wants to do opposite of whatever they told us that they wanted to do or accomplish, then I think there's not a very good match, because what happens is the advisor and the investor, their philosophies have to match. The investment philosophies have to match. And if they don't really match the information that the advisor has, or the experience that the advisor has, and the recommendations that the advisor is making, then it's not a good fit, because
Right.
that always come back to bite you, right? So if the investor is too greedy in terms of thinking that, okay, I'm going to get these high returns, and in office I can make 6% versus 4% in the multifamily property, and they're really only doing it for cash flow, but then the cash flow can disappear if the office occupancy drops to 50%, which is what happened now, right? Around the country, there are some properties that are at 20, 30% occupancy, 40% in major downtown areas in the US. And that's a huge problem for investors, right?
So it's basically a spreadsheet. So like let's say you already funded one property. You would remove that property from the spreadsheet. Then you get
Yeah.
30 more, you put those 30 more on there, and the investors have access to that one spreadsheet.
Yes, yes, yes.
Got you. Okay. So do you give them like an update? Hey, check the spreadsheet. Got 30 more, up, like when you put new stuff on there, do you let them know?
Yeah, yeah. I mean, we tell them, because these are dynamic properties, so there's always movement, because as new equity comes in and the equity is sold out, so to speak, or the property is sold out in the sense, right? So then it's not available, right? So what happens is, even if we give them an updated property Excel spreadsheet, the by the time they look at the property and by the time they decide that this is the property I want to invest in, it can actually be sold out. So to counter that, what I usually say to our investors is that, look, I want you to at least choose 1 through 5 properties, right? So the best one that you like, allocate number one to it, two, three, four, five, right? So give me 5 different choices, and out of that, I would say just go into at least three, minimum three. Diversify minimum three in 3 different locations, 3 different states, right? Um,
So I got a question. It might be a stupid one. You said they have to what's the minimum you can invest as an accredited investor?
well, as an accredited investor, as long as you have $100,000 per property, you can
Also,
invest unlimited property. So if you have 10 million, right? For example, 10 million equity to invest, theoretically you could go into 100 properties, right? But then for 100 properties, if your CPA charges $1,000 per property operating statement, that's $100,000 in tax fees, tax prep fees. So you got to be
right.
aware of the tax prep fees as well, and you have to consider that. So most investors will usually go for 3 different properties. So in 1031 exchange, there's 3 different rules, right? And again, a 1031 intermediary or a tax CPA would be a better professional suited to answer this, but I'll still attempt to answer. Uh, so there's a 3 property rule. So when you do exchange into 3 different properties, you meet the 1031 exchange guidelines, as long as you replace the same equity and the same debt that you relinquished in the previous property. Then there's a 95% property rule, right? You choose an unlimited number of property, 95%, uh, and then you can meet those guidelines. Then there's a 200% property rule, and you can identify up to 200%, and then you have to acquire those properties that you acquired, and that's how you meet the guidelines. So the 95% property rule and the 200% property rule replacement rule is hard to understand and hard to implement. The three property rule is the easiest to understand and the easiest to implement.
Right.
And that's
The
the way.
the main reason I asked is because you said that buy three, and I didn't know if it was going to be 100,000 spread between the three or the 300,000. That's
Three at
awesome.
100,000 each,
Right.
minimum 100,000 each. So uh, it may be a sizable investment for uh, many investors, but for many serial real estate investors who've been investing for 20, 30, 40 years, um, it's usually not an issue because their properties have appreciated, the holdings have appreciated, and they may have $3, $4, $5 million in assets. And it's amazing. I mean, the people that I meet are just everyday people. They could be your next door neighbor um, that you don't know that own that much in real estate. And when you start talking to them, you find out they're worth like 7 million because they have all this real estate. Uh,
Right. Never know, man.
Never know, yeah. So I think real estate is a great way uh, to make wealth and to earn income, especially when you are in your retirement years. I think for the long term, it's really a great way to supplement your income, besides Social Security and besides stocks and whatnot. You know,
Out of the apartments, the medical, the storage, which one do you see is the trumps everything out of those three? Probably multifamily apartments, right?
multifamily apartments tend to be the most stable and usually the best, the most conservative investment, so to speak. But then medical office is another very good investment. That medical offices tend to be leased usually 90 to 100%, long-term leases, triple net leases. Um, Same thing with hospitals. Uh, Same thing with grocery centers, grocery stores. Uh, Essential retail is another good one. Storage is another good one. So if someone had, let's say, $500,000 and they came to me, I would say at least three different properties and three different property sectors within the real estate sector. So maybe 150,000 in apartments, 150 in essential retail, and 150, 200 uh, in storage. Or
Goes back to diversity. The thing you
yeah,
said at the beginning, diversity. Yep.
yeah, because look, one area is not really good. So if you said, look, I just want to invest the entire 500,000 in all multifamily in one location, that's quite dangerous. Because if there's a disaster in that area and that whole building is destroyed in that disaster, then you're going to be in a world of hurt. At the very minimum, your income is going to stop, right? So, uh, so if you were to say, okay, I just want multifamily, then I would say invest in at least three different multifamily investments in three different areas. So you kind of diversify away the climate risk, right? The acts of God risk.
Right.
And the, you know,
How do you like do your due diligence? Like find out if that market's somewhere you want to invest. Like it's a hot market at that time.
that's a job of our sponsors that do that due diligence, that find the markets. They look at the economy of that area, the employers moving in that area, or existing employers, the universities. They look at everything that's material to the functioning of that property or to the value of the property today and future projected value. So in the prospectus, they're really giving you projections based on the trailing numbers, the property performance, if it's slightly older, or if it's new, then the numbers going forward. So whether the actual numbers will be the same as the projections, that no one can say with any certainty. But going into an investment, you have to have some idea as to what the the business process will be, how the numbers will look like, and if the property performed at these numbers and had a 10% return per year, and if we bought the property at uh, 6% cap rate and we were able to sell it at 5 cap rate, right? Uh, then what's the return that we can get, right, on the value. So they do all that projection, but it's all done for you. So that's where the prospectus is very, very important. And I recommend to each investor, please read from the first alphabet on the first page to the last alphabet on the last page. So this way, you kind of know what you're doing, what you're looking to do, what is the risk that's involved, right? And what that property is all about. And then on top of that, just invest some time and money and go fly and see the property, right? The sponsors
Right.
look at the property. You're not looking at 20. You're just looking at the one that you're looking to invest in. But at least go do your due diligence if you're going to be putting $1 million in it or a hundred
Right.
thousand
So
dollars in it.
what happens if you do decide to purchase a retail, right? And it's being leased, and then they decide to leave and it's like vacant after that. How would you handle that situation? Would you just do an exit strategy and get out of it, or just put somebody else in there?
Well, the sponsors look at that. So typically, they won't buy any retail unless and until it has minimum 10 years to 15 years lease on it, triple net lease, right?
Right.
So the triple net is they're responsible for the insurance, they're responsible for the expenses, maintenance expenses, CAM expenses, common area maintenance expenses. They're responsible for the taxes, right? And then if it's absolute triple net, then they're responsible for the roof as well. So they're responsible for the upkeep of the structure as well. So they will only negotiate properties on which there's triple net leases at the very minimum, and the leases are at least 10 to 15 years down the road, right? You
Probably
have
because they're most likely going to stay at that location, I'm guessing, because it's 10 years.
Yeah, they think that if it's 15 years or 10 years, they say, okay, yeah, we're going to be here. But in some cases, like what happened in the case of J.C. Penney's or Mervyn's or Kmart or a lot of these businesses that went bankrupt, um, or Sears, uh, when these businesses left those locations, and let's say they had a 15-year lease, right? Or sometimes Walgreens, CVS's, they will leave a location even if they have a 15-year lease. So if they have a lease, so they're obligated by the lease contract to pay the rent until the lease rent ends, or it can be subleased. So that's the other exit for them, to sublease it. So they have some rent coming in, and then they turn around and pay the rent to the sponsor, who in turn passes it to the investors, right? Uh, or sometimes they will just leave and the store goes dark. So we call it dark. So it's dark, but it's still paying the rent. In which case, the value of that building drops, because now it's dark. There's no tenant in there, so we don't know if a new tenant will come in. So the sponsor will make every effort to release it through their leasing arm, right? And uh, usually they're successful because they have such deep roots in the retail real estate community, and they've been working with all these brokers for many years, so they're able to release it. Uh,
Right.
One of the sponsors that I told you earlier, they have this strategy where they will just buy these absolute triple net leased properties in 3 to 5 years. And they'll say, okay, you can either do another 1031 exchange in another DST with us or with someone else, or you can do an upreat where this money gets absorbed into another real estate investment trust, and then you pay taxes as you withdraw those monies. So they have that option. So they will preserve the investors' uh, tax deferral for as long as possible, right? So those type of sponsors are extremely valuable, who have the means and the strength and the backing and deep pockets to do these types of transactions where they're literally guaranteeing in that way. I hate the word guaranteeing, but at least they're enabling. Let's put it enable. The word is enabling the investor to go from a net leased investment into a REIT, and eliminate some of that non-renewal risk, the lease non-renewal risk, because sometimes these leases may not get renewed if the tenant did not have a very good experience at that location. Or like in San Francisco, there's a lot of tenants who are leaving who are closing their stores, like Target or some high-end stores, because too much theft. They have too much theft in their stores, and they're saying, look, we cannot be profitable in this location, so the only option for us is to close this location, and we're just
Right.
going to the city,
Do,
right?
do you feel that like strip malls and like shopping centers would be more like less risky for retail because there's more um businesses in there?
Yes. See, again, I mean, in terms of risk, the businesses that were essential to the functioning of the economy, they were pandemic proof, economy proof, uh, internet proof, where people need to go in person, right? So yeah, if you have, let's say, a barber as a tenant in your retail in your strip mall, that's a good business. But if you had mom and pop pizza, mom and pop Chinese, mom and pop whatever, all these small businesses went bankrupt during the pandemic, and only the biggest chain stores, they survived, right? Because they had the reputation, they could, do deliveries, they could, you know, all these fast food, all these delivery services could pick up food, deliver, right? So they were in business, but all the small, businesses went bankrupt, you know. So, in a retail shopping center, you have to be very careful. So, if let's say if it's a office where you have all these doctors who are leasing the space, it's a medical office. Now that's a good one, right?
Right.
The strip mall where you have all these various mix of tenants in there, but a thing like the pandemic hits and they'll be affected by it, then you have to be very careful, right? Or the other way to avoid that risk is if you can afford to buy it all cash. So that way you're eliminating the mortgage risk and the interest rate risk. So if you're all cash, and even if the property is leased 50%, what do you care, right? You still have some money coming in. Or even if it's
Right.
vacant, you still own it. But in real estate, in order to increase your cash flow, you need to have some leverage on it. And that's why people put leverage. So, so these are all the considerations that you need to take. Um, but in our world, because these are institutional quality properties and huge properties, a lot of these risks are well thought out, and they try to eliminate or limit some of these risks. And also the other way to limit these risks is to diversify. So if you were looking to buy a retail strip mall, but then I would say, look, you got to have some apartments, some retail strip mall, maybe have a grocery center in there, maybe sometimes you, like in California, we see there's Mexican grocery store, there's a Chinese grocery store, there's an Indian grocery store, and they keep going whether the pandemic is there or not, because there's demand for their types of foods and people will go and buy those groceries, right? So but if you have like a design center, and if you have a non essential business, then that's not going to be very good for you. So then
Right.
the question is, how much risk can you afford to take, right? uh, and then also,
Does your
yeah, go ahead.
go ahead? No, keep going. Sorry.
But then also the other issue is the kind of financing you're going to be putting on it, right? So if you're a conservative investor, then you would go for a 30-year fixed financing. So then regardless of what happens to interest rates, so you can always refinance a property. But if you are forced to refinance from a lower interest rate to a higher interest rate, now that's going to kill you, or might kill you, right? But if you already have a fixed rate, then you already have calculated what the cash flow was going to be upfront before you bought the property. And if the numbers made sense and you could walk home with 4, 5, 6% cash flow, net cash flow in your pocket, you know, that's great. So then if the rates went to 30%, or doesn't matter what happened, you still have your loan at 6%, or
Love it.
8% today, right? So it doesn't matter.
Right. Does your fund do any like development stuff? So like what I mean is, let's say you get a storage unit, right? And has some extra acreage on it. Like if you purchase that asset, would you want to develop something to add value like to that asset?
Yes. So that happens in opportunity zone funds. This opportunity zone, I think it was signed by President Trump in 2017. So essentially, that's a way to defer your capital gains taxes on your investments. And then the look back period from the date of investment is 6 months. So if you were to invest today, 11/17, we could go back all the way up to 6 months and try to limit those capital gains taxes. And those properties are opportunity zones, and they're in less developed areas or distressed areas, um, or areas that need rehabbing, or re-beautification, or whatever you want to call it. Uh, so that's where a lot of our sponsors are doing developments. They're replacing, let's say, apartments with shopping center, or rundown strip malls with high-rise apartments, or a mixed-use, shopping center at the bottom, apartments on the top. So that is absolutely going on, and there's billions of dollars in investments that are happening in the United States all over. And I think also in the opportunity zones through us, they need to be accredited investors, and the minimum is $100,000. But people can look into opportunity zones themselves. Um, I think when you search on the web, you'll be able to find out where are these opportunity zones in your community, and you could target those areas, and you'll be eligible for tax incentives. And if you develop in those areas, then you'd be you get more tax incentives down the road. So
That's awesome, man.
yeah, that's a good way to go about it as well.
Did you see that article? I believe it was like a week ago where they're trying to pass a bill to convert office spaces, like offices, into affordable housing. Did you see that? What do you think?
Well, I don't know if there's a bill there, or it's but there is a an effort underway in in most major metropolitan areas, in beautiful Class A, Class B office buildings, in downtown areas which are vacant or 20% leased or whatever. So there's a effort underway to convert those offices into condos. I think that'll be great. It'll revitalize the downtown communities. And also because of the location, those buildings are in beautiful locations, central business districts. So it would be awesome to see those developments come to fruition if they did happen in those communities. Um, and everyone will benefit. Yeah, I mean, there'll be more housing supply, but it's just very difficult to convert offices into condos for the simple reason because you need to do new plumbing. The offices don't have two toilets or three toilets per condo, right? So
Right. Usually
that
office has just one bathroom, right? Or something.
yeah, I mean on each floor they may have one women's bathroom, one men's bathroom, or two women's or two men's, right, on either side of the building. Um, with 5 or 6 stalls each, and that's about it. But so it's a little bit of a different animal when you're trying to convert to condos. But hey, look, where there's a will, there's a way, and it can be done. Uh, and if developers have deep pockets and good financing to back them up, they can. They can absolutely do it. So that would be wonderful. That would really be wonderful.
That's awesome, man. So let's end it with, because we've been on here for 2 hours and a half. I got one thing that I ask every guest. What are 5 books that changed your life that you recommend somebody read?
Oh, that's a great question. Uh, one book that comes to mind is Man's Search for Meaning. It's written by Viktor Frankl, and he was in a concentration camp, and he was a survivor of that. Um, and he writes this book and how he survives, and despite all the misery that was going on around him, he writes about how sharing his own food and helping others helped him, and how he came to recognize the presence of God, or like the presence of the divine, like how he lived through it. And I think that was a beautiful, beautiful book. Um, the other book that I read was in graduate school when I was doing a master's in religious education. And that book was called, I think, The Power of Myth by Joseph Campbell. Beautiful book. It talks about different myths and in different religious traditions or thoughts or philosophies, and then he compares it with the modern myths in our pop culture, in the movies, and our modern heroes created by these movies. Whether it's Luke in the Star Wars movies, and he's the modern hero, good against evil, that kind of thing. A beautiful book. Um, and there's actually a bunch of books that I've read over the years that were truly fantastic. But these are the two that come to mind. I mean,
I'm gonna
there's
definitely have to check those out. I've never heard of those, man. Like most guests that come in, that they'll say who not how, Go Giver, Profit First Real Estate. It's usually the same ones. I've never heard of those that you said. That's cool.
Yeah, I mean, these are, books with deep meaning, uh, and they give some sort of perspective to the way we live. And when you read these books, they are so spiritually enriching, and even enriching in any sense for that matter. So, you know, I mean, oh, and then the other link that I put in is the our website. It's mymoneymall.com. Um, and then let me also put in my LinkedIn profile in the
To tell the viewers about My Money Mall, what can they get value there? Like what do you offer there?
in the My Money Mall. Uh, in My Money Mall, there's first of all lots of information on 1031 exchange and DSTs. A little bit more description than what we discussed today. Um, and then there's also, I would say, at least 50 to 60 free financial calculators, more than any bank, financial services company, insurance company that you've ever looked at. There's calculators on education funding, life insurance planning, retirement planning, uh, leasing versus buying a car, like everyday things that you look at. Uh, and there's also links to buying life insurance for up to $2 million without any medical exam. But that
Wow.
is for people who are perfect health, have no medical issues, and they will issue it immediately. If you qualify, you go there and you apply online, and no one will call you, no agent will call you. So it's really fantastic, and you can just go do that. And there's and there's a lot of other books that are on our website also. There's some books on financial planning by Susie Orman. She's a well-known certified financial planner. She has her own show, I think, on CNBC. Used to have at least. So that's another. So some of those books are also very valuable to read if you want to improve your financial life as well. So a lot of free financial tools. There's no cost to it. There's also some free ebooks that you can get. So check it out. It's mymoneymall.com. So it's really fantastic. And then I'm also going to put my
So on this chat, like do you see the regular comments on the very top, or do you see just the private chat?
I'm just seeing the private chat. Oh, there's
Oh, okay.
comments.
Yeah, if you post it in the comments, I can just show it on there. On the private chat, no, it's fine. Just put it in the private chat and I'll move it over to the comments and then I'll show it. If you don't see it, I was just curious if you don't see the comment section.
Oh, yeah. I'm sorry. I just put it in private chat. If
What's the link you're sharing? The last one? The third one?
the last one was from LinkedIn, and all of a sudden my mouse is not working. It's acting really weird.
Really?
Yeah, I think it's some kind of a virus, maybe. It happens
Maybe
occasionally.
running out of batteries.
No, it's actually wired. I used to have battery connected keyboard and mouse, and I changed that because it used to have that problem quite frequently. But LinkedIn, so if they search me by Sid Jain, SIDJAIN, uh, comma Money Mall USA. Money Mall USA is the name of our company. Then you will find me on LinkedIn, and there you can look at um, the whole bio data, experience, the testimonials from other clients. in the past and check me out.
Wait, I think I have something right here I was gonna show. Let me see if I got it on my.
Justin, yeah, if you go on LinkedIn, you will see. You will see.
So your mouse isn't working right now?
Yeah, it's not working.
Shit. Let me see. Because I don't have LinkedIn on my tablet. I'm actually on my tablet. Watch, I'm gonna type it into the comment section. Tell me exactly what the LinkedIn is. LinkedIn
Yeah.
dot com.
That I can do. Yeah, LinkedIn.com backslash in in backslash
Okay.
backslash Sid S as in Sam ID.
Sam.
Yeah, S as in Sam ID dash J as in John, A as in Apple, I as in India, N as in Nancy, dash MyMoneyMall, as in the website, MyMoneyMall backslash. So that's the link.
That's a long link, man.
Yeah, that's how they do it on
No,
LinkedIn.
no, I know. I was just messing with you. I know it does that automatically.
Yeah, and then,
Everybody follow Sid. He brought in massive value, good connection to have on your side in the multifamily space, or even just financial guidance. Make sure you follow him. Hey, and I appreciate you coming in, man.
yeah, thank you for having me, Justin. I appreciate it, and I appreciate your listeners. Um, I'm sure they are very interested in everything real estate. But since my background is financial planning, investments, uh, all 9 yards, I also have a master's in economics, master's in religious education. I've attended Harvard Law School, Harvard Business School, and of course, all the different licenses. So I think all that information uh, kind of came in handy. And in the 2.5 hours that we've been together, I think you were able to get the essence of it.
Right. And it's crazy because I was looking at your bio on the Money Mall, and it said My Money Mall, and
Yeah.
it says that you own 1 billion of assets. I found that out today. I was like, dang, crushing it, bro.
Yeah, we've transacted $1 billion worth of transactions in the real estate space, whether it's lending, whether it's helping people to acquire investments, real estate properties, and whatnot. So, yeah,
Like a
that's
mixture of everything put together. Got you.
mixture of everything, mixture of real estate, yeah, and
Love
investment,
it, man.
yeah.
Hey, I'll be getting in touch with you offline, man, so we can make some money together, brother.
Oh, absolutely, absolutely. And then anyone else from your show that is interested in DST Properties, is an accredited investor, please feel free to contact me. You have my website there. My contact information will be there. And also go to our LinkedIn page. I'd love to hear from you guys. I appreciate you.
Hey, you have a good one, man.
You too. Thank you, Justin. And thank you
Thank
to
you,
all
man.
the listeners. Yeah, thank you. Bye bye.